Have you ever looked at a massive company, like a Disney or an Alphabet, and realized you're not just looking at one single business? You're actually looking at a huge family of companies? So how does this giant family, with all its different parts, tell the world how it's doing as one single team? Well, let's dive in.
That really is the big question, isn't it? How does a parent company take all these different subsidiaries it owns and boil everything down to say, hey, this is how much money we really made as a single group?
It all comes down to a special financial document. It's called the Consolidated Statement of Profit or Loss, and it's the tool that weaves all those separate threads into one single story, giving us the true economic picture of the whole group. So, let's see how it's done.
All right, so first things first. Before we can even think about combining anything, we really need to get our heads around the basic structure of these corporate families.
Okay, so it all starts with what we call a parent company. Let's just call it P for short. This parent company controls other businesses which are known as subsidiaries, or S. Now, here's the key thing. Even though P is the one in charge, every single one of these companies is its own separate legal entity with its own set of books. And you can see why just looking at P's financial statements alone would be totally misleading. It would completely ignore what's happening in all the companies it actually controls.
To make this all feel a bit more real, let's use a simple example. Meet Paddle, that's our parent company, and Skip, its subsidiary. As you can see, they each have their own separate profit and loss statements. Our mission, should we choose to accept it, is to combine these two into one single, meaningful report.
So where do you even start with a process like this? Well, the first step is actually the one you'd probably guess. You literally just add them up.
The basic idea behind consolidation is pretty much what it sounds like. You take every single line from the parent statement and the subsidiary statement, and you just combine them. Revenue plus revenue, expenses plus expenses, you go line by line all the way down.
So look at how simple this first step seems, right? We take Paddle's revenue of $2.4 million, we add Skip's $800,000, and boom, we get a combined group revenue of $3.2 million. Same deal for the cost of sales. Seems easy enough, doesn't it?
But of course, it's never quite that simple. I mean, this simple addition works perfectly if the two companies just exist in their own separate worlds. But in the real world, companies inside a group are doing business with each other all the time. And that's where things get interesting.
And this brings us to what I think is the most crucial concept in all of consolidation. I like to call it canceling out the internal noise. So this noise is what accountants call intra-group trading. It's when the parent company sells something to its subsidiary, or the other way around. From the group's point of view, if you're standing outside looking in, you haven't actually sold anything to a real customer. You've basically just moved money from your left pocket to your right pocket. And this example really drives the point home. Let's say Company A buys some inventory for $60. Then it turns around and sells that same inventory to its own subsidiary, Company B, for $80. Now, on its own books, Company A just recorded a sale and a nice $20 profit. But has the group actually earned anything yet? Nope, not a dime. The goods have just moved from one warehouse shelf to another. No real money has come in from the outside world.
So the bottom line is we have to get rid of these internal transactions. If we don't, we'd just be artificially inflating our numbers. The process is pretty logical. First, you find that internal sale. Then you subtract that amount from the group's total revenue, and you subtract the exact same amount from the group's cost of sales.
And there's one more little twist. Remember that $20 profit that Company A thought it made? Well, if Company B is still holding onto that inventory at the end of the year, that profit is considered unrealized. It's not a real profit from the group's perspective because the item hasn't been sold to an actual customer yet. So that phantom profit, it has to be taken out of the final numbers too.
Okay, so we figured out how to handle sales between the companies, but what happens when the parent company doesn't actually own 100% of its subsidiary?
This is a super common scenario. A parent might control a subsidiary by owning, say, 75% or 80% of it. So what about that other 25%? Who does that piece belong to, and how do we make sure they get their fair share of the profits?
Back to our Paddle and Skip example. In this case, Paddle owns 75%. That other 25% we see here, that's owned by outside shareholders. In the world of accounting, this slice of the ownership pie has a special name. It's called a non-controlling interest, or NCI for short.
So think of the NCI as the portion of the subsidiary's profit that rightfully belongs to those external owners. And here's the tricky part.
Even though the parent company consolidates 100% of the subsidiary's revenue and costs because it controls the whole operation, it can't claim 100% of the final profit. That profit has to be shared.
And calculating this is actually pretty straightforward. If we look at our example, Skip made a profit of $40,000 for the year. The non-controlling interest owns 25% of that, so their share is simply 25% of $40,000, which works out to $10,000.
And here it is. This is where it all comes together in the final report. You see, way down at the bottom, the total profit for the entire group is shown. But then it gets split. One chunk goes to the owners of the parent company, Paddle, and that other $10,000 is clearly set aside for the non-controlling interest.
All right, we have covered the biggest pieces of this puzzle. Let's just quickly touch on a few other details before we wrap things up and recap the core ideas.
Now, in the real world, consolidations can get even more complicated. You've got to deal with things like acquisitions that happen in the middle of the year, and all sorts of other accounting adjustments. But honestly, don't sweat those details. If you've grasped the core logic we've just walked through, you have totally nailed the heart of the entire process.
So let's just boil this whole thing down to 3 core principles. It's this simple. First, you combine everything. Add up all the revenues and all the costs like it's one giant company. Second, you eliminate all that internal noise. You cancel out any sales between the companies and any of those unrealized profits. And third, you allocate the results. You split the subsidiary's final profit between the parent's owners and any of those non-controlling interests. Combine, eliminate, allocate. That's it. That is the secret sauce.
So, the next time you pick up the annual report for some corporate giant, you'll know exactly what's going on behind that single set of numbers. It's not just one company's story. It's a carefully built story of many, all rolled into one. The question is, what story will you be able to see, hiding right there in plain sight?